Hello and welcome to Investing Confidential. Apologize for not making too many videos recently. I've realized that making daily videos is basically problematic. Okay. What's more important is getting things right over time, not to get involved in this daily thing about getting you guys to trade on a daily basis. Forget about day trading. I mean, that is a losing proposition. Uh, if you're one of my few but loyal followers, you're not surprised by what's going on in the market, by these market declines. I told you not too long ago that the market had peaked. And basically, what's right now, the way to really understand this market is to focus on positioning. Okay. It was way too bullish, as you can see here. I mean, people were too bullish, too many people buying calls. Uh, you've got hedge funds, which is, to me, most of the time dumb money. They were piling into tech a few weeks ago. I mean, it's unbelievable. And even gold, for example, people were piling into gold. I mean, these commercials now, every other minute there's a commercial on gold. It's crazy. And gold has obviously been pummeled, essentially because of the whole thing's around rates, okay, and positioning, right? So positioning was too bullish. Anything that was pushed too bullish is getting pummeled. Okay, 5, 6, 7, 8% down, and the market was way too enthusiastic. And one of the main reasons was you have a lot of really bad information, fake information. The CPI, it's unreliable, and I made many videos about that. You just people are buying the market because of headline inflation coming down, but they're not focusing on what we've been talking about, which is what commodities. And what are commodities? They're raw materials. These things are not going down. They're going higher. Watch the terminal rate. I've been telling that for 6, 7 months. The terminal rate is the only thing that matters. It is, and you can see here, it's not going down. It's going higher. Okay, look at the 10-year, higher. I mean, look at mortgage rates. I mean, this whole housing situation is another bubble. All right, the housing. By the way, if you're not in New York or Miami, housing's collapsing everywhere. Okay, it's coming down. If you're buying a house, if you're willing to buy a house for the next 30 years, fine, buy it. But if you don't have to buy right now, do not buy. Housing's coming down. Okay, there's no sellers, and the sellers will come because as long as the stock market holds up, people feel comfortable. But the stock market is about to get pummeled. Okay, and it's going to take everything down with it, including real estate. Now, let's talk about the Fed. Now, the Fed has been, and this whole thing revolves around the Fed. The Fed's been doing the right thing, surprisingly so. They know they have to hold rates higher for longer. They're probably going to raise again in September based on, again, what we've been talking about, sticky inflation. Powell, as much as I think he's a dove and he's in bed with his PE buddies, he's worried about his legacy. And as much pressure as they're putting on him, and I'm going to tell you they're putting pressure on him, he's doing the right thing right now. Because what the Fed is seeing is the underlying inflation is not going away. Look at this. Look at what nobody's talking about here. Look at gasoline prices. This is common sense. We feel this every day. Not the elites, but look at natural gas. Okay, spiking. I mean, this is going to significantly impact August and September inflation. They can try to manipulate it, energy and whatever. No, this is going to impact everything. Okay, and the market's not going to like it because the Fed has already told you, and the market doesn't. The market tries to challenge the Fed, and they keep losing. Now, the Fed also sees wages going higher. I mean, there's strikes going on, and then there's settlements and wages going way above inflation. Okay, and then there's some negative stuff that are going to affect the economy that the Fed likes to see, but it is negative in the short term. Okay, we're finally seeing payrolls trend lower. They've been trending low for a while, but focus on payrolls. I mean, these are people working. There's less people working now. Okay, people are getting fired, as we saw. People telling you ignore the tech firings, Wall Street. No, don't ignore the firings. You're seeing the trend. Okay, the Fed. On this number, the Fed wants to see payrolls go negative. Believe it or not, they're not going to tell you that, but that's what they want. Okay, and look at some really interesting stuff. LinkedIn. Okay, here's LinkedIn hiring trend. It's now below the pre-COVID level. Now, I've used LinkedIn to hire people. A lot of people use LinkedIn. So it's actually a very, really good indicator, and it's not good. Okay, here's, job postings. Okay, this is a very interesting statistic. These job postings, this is Indeed and all these other manipulated things, it's finally crashing. Okay, the White House and others use this to basically manipulate the unemployment data. They were telling you, oh, remember that there are 3 jobs for every person, blah, blah, blah. And now there's 1-to-1, and we're going to see less than 1 job coming soon. Okay, and again, this is what all the tech firings, finance, the economy is in bad shape. Okay, and with all this going on, you need tech and if you own New York real estate right now, if you don't sell, you're a fool, because it's coming. Okay, New York's holding up, Miami's holding up, everywhere else is going down. These two regions will not be able to hold up against this type of real pressure on jobs, on inflation, rates. I mean, sell it. Okay, get out if you're in New York real estate. Now, as I said, you have to look past the fake data. Okay, you take retail sales, for example. The powers that be, retail sales are higher. Look, this is a manipulated index. It's based on value, not real retail sales. You're adjusting for inflation. You also look at the actual sales and volume, and things are a different story. I mean, look at Amazon activity. This is not good. Okay, the blue line here, as you can see, is activity now versus the mean over a number of years, maybe 6-7 years. I mean, this is not good. Okay, and if you're so, when you hear in the news, oh, retail sales are better, consumer confidence, and then you look at this and you say, wait a minute, I know that this is more realistic, the Amazon activity. And Amazon, for whatever it is, it's the pulse of the U.S. consumer, and this is not good. Okay, look at small business sales plummeting. This is a disaster. Remember, we've always talked about small business is the lifeblood for any economy. This is a global thing. So here in the US, small business sales are plummeting. Folks, disaster. Okay. Then you follow it up with credit card delinquencies rising fast. So you've got slowing consumer, credit card delinquency, small business sales plummeting, and they want to tell you that the economy is in good shape. Are you kidding me? Okay. And I've been showing you these indicators for some time. The few of you have been following me. And this is what you need to focus on. Okay, and so what now, right? So I still think the market's peaked. Forget about new highs. It's going to be volatile on the way down, but it's going to trend lower. EPS guidance, no matter what you hear, was not good. Okay, you've had banks being downgraded, all of this nonsense. And I just want to mention one thing. You saw that Michael Berry story, he bought a bunch of puts. Look, this guy's a smart guy. He's always bearish, always bearish. Okay, so you really can't trade on his positions because he's always early. He's right and he's always early. But you really, as a normal person, cannot hold on to his trades. Look at the financial crisis. He gets all this, people patting him on the back. You know what, folks? The reality is a lot of people had this trade on. My firm had this trade on. Everyone had this trade on. This is not unique. What made him unique and the others is they were able to hold it because it was a very difficult trade to hold. A lot of guys got carried out, as they say. Okay, look, smart guy, but he's early. It's going to be a bumpy ride down. You're going to have big rallies, this and that, but it's going to be a bumpy ride lower, and you got to be careful. So look, right now, you can go to Morgan Stanley or any of these brokers, Charles Schwab, and you get 5% on Treasury money markets, over 5%. Okay, you got to stay short duration. Okay, U.S. dollar is going to rally because of this whole idea of rates being higher for longer. Okay, that's a short-term thing. Longer term, U.S. dollar is going to get pummeled, but in the short term, it's going to have a little bit of a rally. Okay, again, based on rates. So To sum it up, Fed are going to keep rates higher for longer. This is going to hit the economy. It has to, right? All these PMI numbers coming out, these are not good. They're better, but not good. The Fed wants to see crappy numbers before but the market doesn't understand that. So forget about Wall Street, forget about these forecasters. Every day you can walk outside, fill up your car tank, go to the grocery. You see what's going on. You don't need some moron in Wall Street to tell you that things are good. Okay, stay liquid because all financial assets are going lower. Gold's going to trend lower until when you stop seeing these ridiculous commercials advertising gold bars when those commercials stop, then gold will start to break to the uptrend. But until then, just stay away from it. Hold on to it like I do for the long term, but don't buy anymore. Okay. The uptrend, if you look at any chart, the uptrend for everything is broken. Okay. So be aware. So if you're an investor, be careful out there.